1 second. Perfect. All right, excellent. I'm very happy that everyone could join today, and I'm very happy to have such a great panel for our roundtable event today. For everyone who is listening right now over the YouTube live stream, I just want to point out that we have a Q&A session later on. So please join our chat on Telegram. That's t.me/crypto_traders_international. And then you can ask some questions towards the end of our event today. Great. I want to introduce to you Mike McGlone from Bloomberg, Ki-Young Yu from CryptoQuant, and Dr. Max Ibel from Marem Research and DLT, if I pronounce it correctly. We will have a quick introduction round. Then I would ask every panelist to explain us a little bit more which kind of data they look at, which kind of insight they find, and what they make out of these insights. And then we go into a very general roundtable round where we'll ask some questions. And at the end of our show today, we have our Q&A round. I would ask Mike, Key, and then Max to please introduce yourself.
Hey, Pierre. You got the name. I'm a commodity strategist, commodity and cryptos at Bloomberg. My background is I've been in New York. I'm from New York, but I really started the business in the trading pits. To keep my intro short and sweet, my primary goal here at Bloomberg is focusing on where markets are going and why, and pointing it out to Bloomberg terminals, and that trickles down or up away from the terminal. And the unique thing I like about what I do here is I'm completely neutral. My primary goal is to get in markets right and letting investors decide. With that, I pass it back to you.
Thank you very much, Mike.
Cool. So yeah, I'm Max. I'm based here in Berlin. I am one of the co-founders of Marem Research, and we do a lot of digital asset research. And on top of that, we are building a company with together with a bank called DLT Finance, where we built a prime broker and a liquidity aggregator for institutional clients, so they have a regulated gateway into digital assets with instant settlement functionality and instant clearing functionality. So maybe some words about my background. So I'm originally a mathematician, took a PhD in finance, and then quickly, after a detour in the travel industry, I went into algorithmic trading. And basically, this is where I am today.
Thanks, Max. Key.
Hi, my name is Key, CEO of CryptoQuant. My background is basically a software engineer, and I was a blockchain researcher at Icon Foundation. And what we're doing was just building some kind of Chainalysis that's a anti-money laundering solution. And we've been collecting address labels to become Chainalysis. But the problem here was that I'm not a B2B sales guy. So we kind of pivoted our business model to data provider for hedge funds and crypto traders. So CryptoQuant is a blockchain data provider. We provide flexible analytics toolkits for crypto traders. We're developing blockchain matrix that this industry has never explored before, and finding insights that are highly relevant to professional traders, and we bring it to them. So yeah, I will show you our product later.
Thank you very much, Key. And we are looking very much forward to see more. Great, Mike. I would start, or before we start today, I think we can very confidently say that we have a well-rounded panel today with Mike working at Bloomberg monument in the financial space, having a very broad understanding of all markets that are out there. and Mike pretty much being the only person at Bloomberg who's analyzing the crypto space. And I think looking at the entire market with a macro perspective, Key, who's been a while now in the crypto industry, is providing on-chain data to crypto traders or to traders in general. And Max here is working on the exchange side. So he is he's very well capable in looking in greater detail to what is going on exchanges from a data perspective. But okay, now I want to have a quick chat a little bit with Mike and have Mike tell us a little bit of the typical things he's looking at and which insights he's uncovering there.
Thank you, Pierre. Just to clarify a little bit, at Bloomberg, in Bloomberg Intelligence, which is our research group, I'm the primary person really focusing on the crypto outlook. We have a lot of people covering fintech and things like that. But there also is plenty of journalists and media that focus a lot on Bitcoin and cryptos, and a lot of times I trickle up to them. And the key thing I've been watching lately is, let's start with the micro. And that is Bitcoin breaking out versus the NASDAQ. They've been locked in on 1-to-1 basically all year, just fluctuating around there. And finally, Bitcoin's breaking out, NASDAQ's breaking down. I think that's highly significant because we have Bitcoin's one of the few major assets in the entire planet where volatility, 260-day, I'm just using an annual measure, is actually declining. Virtually every other asset in the planet, volatility is increasing. So I've been waiting for this breakout and thinking this is the key divergence where we're seeing the actual Bitcoin rallying and equities declining, because I figure that's potentially bigger picture. I mean, equities don't have to decline, but I mean, Bitcoin not losing its correlation to the stock market. And there's some key reasons to drive that. And we all know the key primary thing I think to focus on Bitcoin is this declining supply. Next year it'll drop below 2% on an annual basis, and the halvings coincide with U.S. elections, and of course the next one will be 2024. And by that time, annual Bitcoin supply will drop below 1% on an annual basis. It's significant because the average new mining supply of gold over time is around 2%. So we have supply declining. We all know what's happening with adoption and demand. I can point out that in a little bit, but all my indicators are still point positive for that. So as a strategist, prices have to go up. And then I look in the macro. It's pretty significant increasing amounts of QE, quantitative easing from central banks, global central banks, and debt to GDP. Let's just look at US debt to GDP, for instance. It's running around 140%. Just a year ago, it was 1%. I'm sorry, it was 100%. So it's jumped up significantly. So to me, there's your major big picture and macro picture. Technically, the market's breaking out, certainly versus the NASDAQ. Bitcoin is held above 10,000. Now, actually, the average price this year is above, it's almost 10, I think it's 9,500. That's the highest ever. And the question I have to ask ourselves is what's going to take for this to fail? I need to see signs of something changing. Otherwise, as a strategist, I have to keep predicting higher prices. With that, how about if I pass it back to you?
Thank you, Mike. What do you think, which are the macro events that have been playing a very important role in the past in determining Bitcoin's price, and where do you see, especially with recent events, that things might changing, especially this year?
Well, the most recent, and as some people claim the most significant this year, is PayPal adopting and allowing Bitcoin for its 350 million users or so as a form of payment. And I don't view that so much, or cryptos. I don't view Bitcoin as an ideal form of payment. I view it as an ideal form of digital gold. But the point is, it's becoming part of the mainstream. In the past, PayPal really pushed against. We have MicroStrategy and so many other firms getting in and understanding that, well, maybe I should hold this as part of a diversified portfolio. And that's the way I've always looked at Bitcoin, is the risks are probably greater as the world becomes more adept to provide massive amount of fiat money, that you should have some forms of stable forms of holding that. So that's the key thing, PayPal. And then also the OCC in the US aligned banks to custody Bitcoin. Those are some of the key things this year. I think things to look forward to as we potentially move into another US administration is a potential for an ETF in the US. Now there's plenty of ETFs in the world. There's exchange traded products, there's trusts. Canada just launched, it's launching one soon or has. And it's just a matter of time. And one way I really look at is indicators for that happening is futures. So if we go back a little bit, one of the most significant things to on-ramp Bitcoin and cryptos into the world of institutional and mature adult investors was futures, because futures brought in the US regulatory environment, CFTC, and it's just a matter of, you know, the next iterations. And I see all the iterations positive. We have to expect volatility in that. We have to expect issues. There's going to be hacks. There's going to be thefts. And it's new technology. I mean, internet wasn't perfect when it first started, and airplanes weren't either. So it's just a matter of time. And the next thing I think I look forward to, the next big thing in this, at some point, we'll see how the election works out and see how that might change the potential for an ETF in the US.
Do you see that in near term, more and more corporates will join the market and will have an impact on demand of Bitcoin? As you said already, the supply is getting more and more scarce. Do you think that will have a dramatic impact on price? And if it will have a dramatic impact on price, do you think corporates will still think to join the game?
I think what you just picked and noted was something very unique about the Bitcoin space, and that is higher prices actually increase demand, partly because Bitcoin right now is what, 240 billion or so. It's too small for many major pensions, funds, endowments, corporations, some, and certainly for central banks. So add a zero to that, it becomes more widely adopted. So I think it's right now, as some people have called it, like Mike Novogratz, Bloomberg and Galaxy have done things together. He's called it the herd. And this year is a good indication the herd is on its way and herd's moving. And I don't see what's going to stop it. They'll have to, I expect there'll be some things I can't predict, but I don't see that slowing. I only see it accelerating. And that's the key thing I started out with earlier. Once the major US investor base in the planet, that's US investors, figure out or find out and discover or worry that the US equity market will not give them the returns they have in the last 10 years, that might have an underperforming period, they're going to be looking for alternative assets. Gold's been one. Obviously real estate, and I think cryptos are just starting to trickle into that space. And right now it's still very much minor holding.
Okay, thank you very much, Mike. Before I go over to Key, Max, you said you might have a few questions as well for Mike. And Key, of course, you also are very welcome to pass over a few questions to Mike.
Yeah, I mean, given my very, let's say, Eurocentric view on the whole space and when it comes down to also regulations, I feel like most of the big institutions don't yet have the regulatory mandate, are not allowed by mandate to invest into this asset class. Usually when they are when they want to shift risk, they go from bonds to whatever precious metals, and this is the best that they can do. And they don't have the mandate to go over to diversify into crypto. So do you think regulating this space a little bit better will lead to the point that they change their mandate, and based on that, this will lead to an influx? So what we are actually waiting for is a proper regulation of the space, and not some open question, where's this going from here?
Yeah, I can't see how it's going to go backwards. Regulation, it's part of that rising prices, more demand. All I see is more demand. Increased regulation is actually good, because it takes, I know some of the maximalists don't agree so much. They don't like the fact that it's coming into the broad space. Well, that's just the way life is. If you expect it to really grow, but I don't see what's going to stop that. And I don't think European or US legislators are naive enough to legislate this or try to legislate this way. I think they get it. At least my sense is here, they get it, that, and I don't think they view it as too much competition yet, that they wouldn't do like the US did, banning, confiscating gold in the 30s. So let's hope that both our leaders are smart enough to know that this is where it's going, and be part of it, join it rather than fight it.
Cool.
Great. Key, do you might have any questions?
I have a question too. Basically, we've been looking on-chain metrics called tokens transferred and exchange fund flow ratio. Tokens transferred is the number of Bitcoins that transferred on the Bitcoin network, and exchange fund flow ratio is the ratio between the tokens transferred on the exchanges and the total tokens transferred. So basically, the exchange fund flow ratio is very low, and tokens transferred are increasing, which means something OTC deals, massive OTC deals are happening outside. So we actually predicted the MicroStrategy's massive OTC deals last month. So we saw lots of OTC deals are ongoing. So do you think PayPal or MicroStrategy and other conglomerates are buying Bitcoins? Which entities are buying right now? You think?
Well, that's the ones we heard of. There was another one I heard about last week that got lost in the fray of PayPal. I forget the name of them. I just heard it in one of the main.
Stonebridge, was it Stonebridge?
There you go.
15 million?
That might have been the one. It was pretty decent amount. But I like. I remember when I saw your bio, I was really impressed. Both my colleagues I'm speaking with are quite the quant involved, and it's the on-chain analysis that I think I'd really like to learn more information about. But I don't see how this is going to go backwards. I understand how MicroStrategy and MicroStrategy did was a bit complicated. I mean, I used to be an over-the-counter option market maker, and it's not free money. I remember when it's very simple. When you call up a dealer and or these days you don't call, but you maybe text, and you ask for offers or bids, the minute you ask for that, the market will move because that dealer will know he's got to hedge himself. So it's how they did it slowly and meticulously. My sense is that we're going to look back on that similar to the way we look back at it as a 10,000 Bitcoin pizza, that it should be much easier in the future. And the best way for depth and easy to really continue is to basically increase the price, just like gold. I mean, you increase the size of the market. But as far as I love to see more indications like from you, where you see this type of activity happening. Like I heard things what's happening with network value transaction ratios and Bitcoin wallets, Bitcoins leaving on exchanges, indications of more demand. But I'm always looking for those kind of indicators.
Great. I think with that being said, we can go over to Key now and hear a little bit more. By the way, Mike, you mentioned, I think in our previous conversations that you might want to share a few of your analysis, but I think with the technical challenges you have currently, that's not possible. However, I think we're getting a lot of your reports via email, and we always share that with the community. So afterwards, we will do that as well. But Great. I think Key, you have the opportunity to dive into your platform. But before, please tell us a little bit more. We had a conversation before this call, and this the pure amount of analysis and indicators and ratios you guys found there on chain is completely impressive. So maybe you want to give us just the top 3 or 4 and tell us in general and what you guys are looking at and which exciting discoveries you guys could uncover.
So let me show you some charts.
Please. That's what we've all been waiting for.
Can you see the presentation?
Yeah, but also with your speaker notes attached.
Okay, wait a sec. Okay, I think.
Yeah, it's still the app view.
Okay, cool.
Yes, now we have full screen. Yes, yeah. Wonderful.
So, like I said before, I was a software engineer at Icon Foundation, and I recruited a team to build Chainalysis. So we've been collecting since 2016, collecting address labels. So when it comes to collecting address labels, well, if you collect those address labels, you can basically predict Bitcoin price movement. So exchange determines price, right? And when those entities like miners, early investors, hedge funds, they send a huge amount of Bitcoins to exchanges, the price is likely to be changed because the purpose of exchange is just trade, right? Buy or sell Bitcoins. If you send some Bitcoins to spot exchanges, that's gonna be a selling purpose. If you send Bitcoins to futures exchanges, that's gonna be a trading futures by leverage. So we have over 33 major exchange address labels and 22 mining pools and miners that covers over 98% of recent who mined Bitcoin in recent 2 years. So let me give you a brief intro to our charts and matrix. So all exchange inflow mean is the average amount of Bitcoins that's deposited into all exchanges. So it's really helpful to see dumping risk. So if this value goes above 2, in the short term, the price likely to be dumped by those whales. And if this value under 1.5 BTC, we're safe from dumping. So let me show you the historical data. In 2018, when this value hits above 2 multiple times, the price is dumped like over 30%. And I would say those whales are leading whales, and the whales who deposited to exchanges after the certain inflows, that's the victim whales. So it's very important to see when those value hits for the first time. For 2019, there was no significant inflows there because we're just the bull market. In 2020, we hit on the March 10th, we hit 2.5, and then the price was dumped. So, and after the consequent inflows are victim whales. So I would say those inflow mean is really helpful to see when, in the short term, when the dumping happened. And we have exchange whale ratio. This is helpful to see how much gonna dump. So it's exchange whale ratio is the relative size of the top 10 inflows to total inflows by day of each exchange. So this is for all exchanges. When you apply 90 days of moving average, you will get a sophisticated whale dumping signals like this. So if this value over 43%, then there is a high risk of mass dumping. So when this value hits over 45%, the price was dumped like over 40% like this. Mm-hmm. And I specifically mentioned that when at the end of July or early October, the whale ratio hits the year low. So you have to buy at around 10K. So it actually goes up. Let me show you the recent data. So this is recent data. So as you can see, actually, when this value hits the bottom, the price was actually the bottom, local bottom, I'll say. So we're pretty much safe from dumping. So when this value hits the 45% again, the huge dumping is likely to be happening again. So this is long-term whale dumping dumping signal. And for
So
exchange
basically, just
Yeah,
to summarize the two last charts you were showing us, it's basically showing when whales are moving their crypto to exchanges, there's huge selling pressure or likely potential that that they're gonna sell their crypto.
exactly.
Or the other way also around, when crypto is moving away from exchanges, from whales, then price is going up.
Yes. So there are so many entities like illicit funds, miners, merchant services, gambling. Those people, they have to send Bitcoins from their personal wallets to centralized exchanges or decentralized exchanges to sell Bitcoins. So if whales are active on centralized exchanges, the price is likely to be dumped or like there's going to be a high volatility. So
at this point, while we're talking about exchange activity, maybe we can shift before we already go into detail what Max is actually looking at, but we already know he's looking at some exchange data. Max, can you share a little bit of your experience here in what happens when a lot of crypto is joining exchange or leaving exchange? Do you see that on your side as well when you analyze exchange data?
Not necessarily, and not so much. We are more interested in the very short-term price movements as liquidity aggregators and all that are also involved in market making activities. We're pretty much interested in the nuances and the small price changes that can happen on the exchanges. So we are mainly concerned with market data such as order book data and trade data, but we also constantly analyze latency data to the exchanges and also arbitrage data. So I can go in some more detail, or we wrap up what Pierre has to say probably.
Yeah, we're going into detail in a few minutes.
Yeah.
Excellent. Okay, well, that's good to know. Key, please go ahead.
So yeah, we have an exchange Netflow, that's inflow minus outflow. Netflow is likely to keep negative when the bull market is about to start. And on the other hand, if the exchange Netflow keep positive for a long time, it's likely to be bearish.
Just a quick question here for the audience. What is Netflow?
Netflow is inflow minus outflow. Exchange inflow, that indicates exchange deposits, and exchange outflow, that indicates exchange withdrawals. So when those Netflow is kept negative, people are more doing withdrawals. They send a large amount of Bitcoins from exchanges to their personal wallets.
For potentially holding cases, long-term holding.
Yes, because they can't trade unless they have Bitcoins in the exchanges.
Interesting. Thanks.
And we have miner position index. It's miners, they send a certain amount of Bitcoins to exchanges periodically. So when you see miners data on our website, there are 22 mining pools and miners here. You can see whenever a certain, black swan happens, they send a unusual amount of Bitcoins to exchanges or other, wallets. But normally they send a pretty certain stable amount of Bitcoins to other wallets like this. So whenever miners think price is likely to be top, and they decide to sell some Bitcoins, they send an unusual amount of Bitcoins to other wallets. So we can see their activity, like all miner outflows divided by its 1 year moving average. That's the miner position index. And as you can see here, historically, when miners move a large amount of Bitcoins to other wallets, the price is likely to be top like this. So we are in the bull market. So it's really important to see when those miners are moving Bitcoins to other wallets. And that would be, that would indicate the price is likely to be top. So that's the
Right.
miner.
In respect to the time, and also I would love to discuss the question if we are right now in the bull market or not later on with all three of you. Yeah, in respect to the time, I would like to ask to switch over to Max now, so he's explaining us a little bit about what he's doing.
Sure, absolutely.
And then we go into the general questions around.
Sure. So yeah, as I said before, we are mainly concerned with the small price changes and the very, very short-term price movements in the market. And for that, we are investigating market data, like order book data and trade data, but we are also looking into latency data to the exchanges and arbitrage data. So trade data, so past trades, we use in order to determine the velocity of the market. So to determine, like we use, for example, an indicator such as how many trades do we see per second to estimate how many traders are currently in the market. And we are also trying to determine who is actually in the market. So many small trades.
Can you repeat that? How true?
Like who's actually in the market? So who's currently trading? Is it more professional guys or is it more some retail guys? And if you see very small trades, very evenly sized, that indicates that you have more retail traders. So trade data mainly serves the purpose to determine the velocity of the market, to determine how many people are currently trading on a certain exchange, which helps us then to determine, okay, how real is the volume that we're currently seeing, and is there someone trying to manipulate the market to a certain extent. The second kind of market data that we're using is order book data. That helps us also to analyze fake volumes. You know, as a liquidity aggregator, we are constantly concerned with fake liquidity. If one of our clients is trying to place a large block order and they want to have a rapid execution and don't want to wait for some iceberg order to be filled, they want to be sure that they want to have a market execution, and we have to make sure that the liquidity in which we are sending this order is actually real, and that the market is not spoofed by someone and someone's trying to actually manipulate the market. Because if the market is manipulated and if they're spoof orders, it means that if we place large orders, that these orders will probably go buy deep or sell deep into the order book and gives us a very, very disadvantageous price that we don't want to have. The second thing that we use order book data for is to determine also the velocity in the market. If we place an order and the order book is changing very, very rapidly because a lot of people are trading, it will be hard to determine upfront how deep we buy into the order book and what kind of an impact we will have with our large order. And these two indicators help us significantly to make a better prediction on how this can work. And one more indicator that we use is that we're constantly checking the latency we have against the exchanges. So often enough, orders get stuck on the exchange side and we have slight latencies on the execution, and that indicates to a certain extent, okay, how busy is the exchange at the moment. And we keep observing that so we can further say, okay, the activity on the exchange is very high, but it also helps us to, if we observe that over time, how much of an effort or how much does the exchange improve their own infrastructure to make markets in general more efficient. So efficiency of the market and detecting fake liquidity is basically what we are trying to do, which helps us to better to adjust our models if we want to place large orders, but also if we want to conduct proper market making.
A few things you mentioned here. In terms of what you're tracking and what you're looking at, could you talk a little bit about the exchange inefficiencies you still see, which you just mentioned, and maybe compare it to what traditional institutional investors are used to from the traditional markets?
Oh yeah, so I mean, it's very, so the first of all, the connections to the exchanges, from one exchange to another, it's the APIs, they are quite different. And if you look at traditional finance, if there is a unified access point, which is usually the fixed protocol to access these exchanges. And there is also a uptime guarantee on these exchanges in order to place your orders and to do whatever. And the crypto market is completely different. Some of the exchanges, if volatility goes only slightly up, you see the problem that these exchanges return errors such as overload of their system, because they have a very predefined queue length. And if you place your order and the queue is already full, your order will be rejected. Or sometimes for some exchanges, you wait sometimes a couple of seconds to get order confirmation. That's an absolute nightmare. And if you tell that to an institutional trader, they will just laugh you out of the room. Yeah.
In terms of the market manipulation that you've been talking earlier about, how often do you see that happening? Is that a regular thing happening in the crypto market, or is it did that change over time, or is that something that's really rare?
I would say, so it changed over time, and it got less and less, or it's getting less and less, and it's better and better detected by the exchanges, unless the exchanges do it themselves, which I can't say if this is true or not. So this is for others to determine, but it's also about velocity of the market and how quickly we can place orders. And maybe one more word, not about only exchange efficiency, but also about market efficiency itself. So we keep observing the arbitrage opportunities that are open in the market, and what we see and what we experience is that the duration these arbitrage opportunities are open is getting smaller and smaller. So 2 years back, you had minutes. You could do this even manually and jump on exploit an arbitrage opportunity. Today, you have to have mostly even your servers very, very closely located to the exchange servers. This is still different on the derivatives exchanges, where you can conduct cash and carry trades. There, it's still a lot different, even though there is a bigger volume. What we still see is that it's not as fast when it comes to closing arbitrage opportunities. We would say that it has mostly to do with the lack of regulations in the derivatives market, which is far less regulated than the actual spot markets.
Interesting, and it probably also interesting to see, especially what just happened with the CFTC accusing BitMEX of criminal activity, of money laundering, right? And now we're seeing the CME as the second biggest exchange, derivatives exchange worldwide. I think it will be also very interesting to see how regulated exchanges are improving over time in terms of liquidity compared to our general crypto exchanges we are having right now, which are having still these technological inefficiencies that you mentioned.
Yeah, that is true. That is in fact true. I would say for the last 2 years, the derivatives exchanges definitely have been the winner. And then, I'm sorry, the unregulated exchanges have been the winner compared to the regulated. But as the as the regulatory bodies across the world are closing in, I think there will definitely be a shift, which I would say we haven't seen yet, but we are about to see for sure.
Great, thank you. Then now, thank you very much for your insights and for the intro about what you do specifically. Now I'd like to go into our more open round of questions that I'm directing to all panelists. And I'd like to remind our audience and all the viewers out there to prepare for our questions and answers round in about 6 to 10 minutes. Please go on t.me/cryptotraders_international. Sorry, t.me/crypto_traders_international and ask your questions in about 6 to 10 minutes. And then we will have them answered here by our panelists. All right, first question to our dear panelists. Do you think we are currently in a bull market? Let's start with you, Mike.
Yeah, I love that question. Okay, well, yes. How do you define it? Let's narrow it down simplistically. At the beginning of the year, my target in Bitcoin, initially resistance target was around 14,000. We're basically almost there. At the time we're speaking around 13,500. That'd be 100% change on the year. That's simple, normal volatility knocking around mean reversion. Last year's high was around 14,000. And so to me, the market's just consolidating the big parabolic games of 2017, and it needs a good reason not to go higher. It's a question of when and what catalyst will get it to sustainable 14,000. So I pointed out earlier, I see a transition from the outperformance of the equity market towards an outperforming crypto market, most notably Bitcoin. And let's put the risk on this. Yes, definitely bull market. If you look at simplistically, just measuring the last time Bitcoin went from 1,000 to 10,000, basically added a zero, it took 4 years. Okay, so we got to 10,000, we've been hanging around 10,000 for 3 years to get to the next zero, 100,000. Double the time because of maturity, which should take about 2025, unless something goes wrong. That's just taking the normal pattern, adding maturity, only doubling simplistically. We should get to 100,000. The question is, how much is going to be that value of the currencies it's denominated in, i.e., is it, the euro, the dollar, it's a piece of paper declining, and of course, this store value is increasing. So the risk, I think, is sustaining below 10,000. So as Max would say, I enjoyed really listening to both my colleagues' presentations because it brings back some of the things I've done in the past, being an ex-trader in the pits. You care about every little tick sometimes. And so here's my stop. The stop is you don't want to stay much below 10,000 but that's just putting the stop on it. And we should continue to march higher and just looking for reasons to not to.
Thanks, Mike. Key, what's your take? Are we in a bull market right now? Not in. I already can assume your answer because I've been looking at your content from the past months on Twitter and on Telegram. But I'll give you an opportunity to answer that yourself.
Yeah, I always mention the Bitcoin price in the long term is gonna have to go up, and let me show you some charts. Like I said before,
show us the charts.
Yeah, I tell something with data. So, like I said before, and Mike also mentioned, a lot of conglomerates and companies are buying Bitcoins in the OTC market. As you can see, tokens transferred increasing and funds flow in the exchanges are decreasing. So it's for one, OTC deal market volume are increasing, and miners, like I said before, MPI, if you see MPI indicator, they don't sell. Miners not selling right now. So if we're at the end of bull market, the MPI value is supposed to be like this much, over 1.5.
Sorry, Key. I think you switched to a different view. We're still seeing your presentation.
Oh, okay. can you see the chart?
Yes, now we can see the chart.
So I specifically mentioned that the bull market is about to start when the value is like here. So we're definitely next bull, and miners are not selling, OTC volume is increasing, whales are not active right now. So I think the prices have to go up at least 14K, because around 14K, miners are fighting each other because they don't want new competitors joining in the mining industry. So they sell some big amount of Bitcoins. So I think around when we hit the 14K MPI value and miners activity they're gonna do something. So it's really important to see miner indicator for now.
Great, thank you. And I know you have way more indicators that are pointing out that we are in a very exciting time right now in the market. But I'll let the audience explore that on your website, CryptoQuant.com. And now, Max, I'd like to hear your take on if we are right now in a bull market or not.
So I don't have a very strong opinion on this, to say this up front, on whether
I
we are
remember,
in the,
that's very true.
and as a very short-term oriented company, we are less concerned with being in a bull market or in a bear market. But having said that, I don't currently see many news that would speak for a bear market. We have a regulation closing in Europe, at least within the next 2 years, which would be a very, very strong signal for the market. You have a market that is still more or less uncorrelated to traditional finance, and given the vast valuations on all other asset classes, there's still a very strong need for diversification for all kinds of investors. So this is fundamentally strong news. But if we are currently in the bull market, how long it will last, I don't have a strong opinion on this.
Fair enough. I know you are trading in and out every few seconds. But I think also in terms of probably customer demand and how well your business is progressing, is there an indicator that demand is going up currently, that you guys are in a better position than, let's say, 6 months ago or 12 months ago?
Oh, that's for sure. So there's definitely an openness from the client side to enter the market. There's also an inflow that we see into, let's say, non-US dollar fiat pairs, which is also, I would say, more or less, and it could be understood as an indicator that the market is maturing. But on the sales side, there's definitely more interest there for sure.
Great. Then we have a few questions in here from our audience as well. Let's switch back to our gallery view. In terms of participants in the market, I think Key and Max, you've been touching on that slightly. Mike, you a little bit as well. Where do you see the larger share of entities right now, on the retail trader side or on the institutional trader side? Do you see that things have been changing recently, or do you still see the same split of entities? Mike, what's your take on this?
Did you say Mike? I'm sorry. I'll address that real quick.
Yeah.
The key things I watch that are simplistic real time are GBTC, the Grayscale Investment Trust. It's running around almost 500 million Bitcoins right now. The key significance of since the halving, it's absorbed 70% of all new mining supply. So that's a key indicator I watch for what's trending, and that's online, it's on chain, it's regulated. It's not on chain, I'm sorry, it's regulated. Addresses used, I watched from Coinmetrics. addresses used have been trending to me in a pattern that's more equivalent with Bitcoin closer to 15,000 than where it is right now, just below 14,000. That's on an auto-scale basis since 2017. That's one on-chain metric. And then, of course, open interest, futures open interest, clearly moving from the lower left to the upper right. The significance of futures open interest, it's about 1/10 the size of Grayscale, so maybe only around 60,000 Bitcoins. The trend is positive. So to me, those are the key few things I watch. Obviously, I watch hash rate. Hash rate's a bigger picture. But anything I can, and a lot of the stuff I think, I mean, whoever you want to transition to next, Key has a lot of cool stuff that I'm looking forward to digging into more. So I'll pass it back to you, Pierre. You can move it on to either Key or Max.
Thank you very much. Key, what's your take? What is the share of the market right now on institutional investors and retail investors? What do you think are most investors right now? And has it changed over time? Are we in a different stage of the market right now?
So I think since March this year, institutional investors are more active. So before the great sell-off on March, the significant inflows from Gemini and OKX was happened. So which means more institutional whales are more legitimate whales are active at that time. So we've seen some kind of correlation with NASDAQ and Bitcoin price for a while. That's that all of those are from legitimate are evoked from legitimate whales, I think. And exchanges are more important players for now. They issue more and more stable coins as they got more revenue from. They are the only player that make a huge amount of money in this industry in terms of revenue. So for example, Binance, they issue BUSD, and the number of BUSD is skyrocketed recently. Whenever BUSD is deposited into exchanges, the Bitcoin price is skyrocketed as well, and BNB price as well, which is weird. But anyway, exchanges also another big player. They're becoming whales as well. Yeah.
Thank you, Key. Then Max, what's your take? And just reminding you guys on the time, I have one more questions here from the audience that is going to Mike, and then we need to roll up our session for today. So Max, your quick take on what's the bigger share in the market right now, retail or institutional, and has that changed over time?
Well, we definitely see it's still more retail activity in the market, especially on the derivatives exchanges. There's definitely more retail going on. However, the whales we can group in two, or we can actually group them in two parts. The one part is really the proper institutionals, and the other ones are proper crypto whales that actually grew their wealth throughout the whole ICO hype and so on. So especially on the sell side, you see a lot of those companies that have conducted a very successful ICO that are trying to liquidate some of the assets that they actually raised, and this is a lot of on the whale activity side that we see. But the picture is changing significantly, and it's changing relatively rapidly, so that we can say, okay, there is institutional money that is flowing around, and the liquidity that they are producing and the volume that they are trading is definitely increasing.
That's great to hear. And I think our bullish sentiment here today on the show already moved the price of Bitcoin, which is currently at $13,567. So thank you very much for your insights, gentlemen. But last question, before I ask the last question to Mike, I want to hear your end of year prediction, what the price is. But Mike, the question that's been asked here from John is, you mentioned the US election will have an impact on Bitcoin movement. In your opinion, who will have a greater impact if elected? Trump or Biden, and why?
First of all, I think we're going to have a Democratic sweep. Pendulum in U.S. U.S. elections usually swings, and I think it's going to swing from extreme Republicanism to Democrat, and then come back in the midterms. And I think that'll mean more regulation, more taxes, major, hopefully not too much to pressure cryptos. Trump's quote mantra has been really hands off. So if per the unlikely event he gets reelected, it's basically been hands off, except for more. Just enforcing laws. But I think the Biden administration will be more likely to massively increase the quantitative easing, the fiscal stimulus aspect of the macro, which will be good, and not mess it up too much. I think they're smart enough now not to mess this up. So I don't think the regulation is going to be a problem. It's the key thing to note is we're probably going to get a new head at SEC, and it can't get much worse. So the SEC, new head at SEC might be more likely to approve a Bitcoin ETF, which is the key thing for Bitcoin. I mean, once that gets where your mom and pops can push a button and buy it and not worry about it, not have to, worry about this silly internet money, and hold it themselves. So that will be the key nuance. So I do expect a Democratic sweep, and I do expect a new head at SEC, and then more likely to get an ETF. So those are potential iterations that I'm looking for.
Right. And then your year of the end estimate of where the price will roughly go?
Higher. I'm really, by compliance, I'm not allowed to pit targets on markets, which is great. It's easier because that's, as Max and Key will show you, sometimes that's the worst thing you can do is do both, targets and price. So I just, key point is I viewed 14,000 as the key hurdle this year as far as resistance, and I do think the market will break above that level, but might show some problems initially.
Thank you very much for your insights, Mike.
Thank you for having me.
What's your take? Very quick.
Where are we going? You say, or on the election part?
Yeah. What's the end of the year pricing for Bitcoin? What's your estimate?
I can tell you 3 minutes before we have end of year. Then I can probably tell you.
All right. Very fair enough. Key. Last but not least, what's your take on where the price will go for the end of the year?
Price will hit 14K, and then depending on how many conglomerates and companies are buying Bitcoins, we can break through 14K, or miners will sell. So market is gonna be bearish if no more companies are joining this industry.
Very interesting. Thank you very much. And at the very last, if our audience is interested to reach out to you, where can they find you best, Mike?
I'm on LinkedIn and on Twitter. You can find me in Mike McGlone 11, but LinkedIn, just look for my name, Bloomberg. Excuse me, I'm there.
Excellent. Max, where can they find you?
Same here, on LinkedIn is the best way to go.
And Key?
I prefer Twitter.
Wonderful. Then, gentlemen, thank you very much for this wonderful roundtable session today. I could have sit down here for a few more hours with you. I personally have so many more questions. Maybe we will be able to do a breakout session with each and every one of you very soon, because I think our audience also very much enjoyed it. Thank you very much for taking the time. It was a pleasure to have you on the show. And let's go into the rest of the bull market.